Hello and welcome back to the Junior Achievement Stock Market Challenge. My name is Mark Wyan, and again I'll walk through the slides today for session 2, stock price movements. So in session 1 we talked about what a stock actually is, which companies decide to go public and why you as an investor may decide to participate in an IPO or initial public offering of a company's stock, why you would decide to purchase that stock and become a shareholder in the company. Today we're going to explore a little further why one would want to be a shareholder over time, why a company's stock price may increase or decrease over time, and we'll talk about the factors that increase the demand for stock as well as some factors that might increase the supply of a stock. So again, why do investors want to own a stock? Well, we're doing it to make money, to make an investment. And through owning a stock, there are two ways to grow your investment. The first is through dividends. Again, dividends are a percentage of profits made by the company that are paid periodically to shareholders. That is, if the company decides to pay dividends. The second way to earn money is through what's called capital gains. That would be the appreciation of the price of the company you own or the stock you own. And how this happens, well, it's really important to remember, it's often said the stock market is forward looking. So in aggregate, the market is determining a price for a share of a company based on the future prospects of growth, right? So if you think that a company is actually worth more than what is reflected in its stock price, if you don't think the market is fully valuing future growth potential and profits for that company, then you would want to purchase that stock with the expectation that the price of the shares would grow over time. Now, it's really important to remember that the value of a company, what it's truly worth today, is not necessarily the stock price, right? And that's the whole point. However, the stock price is an important determinant in valuing the company. So let me explain that. Here's an example of two household name companies with different stock prices. In the top chart, we see that as of January 7th, Microsoft is trading at $103.02. Home Depot is trading at $177.88. Now, which stock or company would you say is worth more? To answer that question, we actually need more information than simply the price per share of the stock. I often hear people ask me about a certain company and say, well, trading at this level seems expensive. And that actually doesn't really tell you anything about the expensiveness of the stock. What you actually need to know, or need to calculate, is the share price by the number of shares outstanding. How many shares are out in the market currently owned by investors around the world? So in Microsoft example, we take the share price of 103.02 and we multiply it by the number of shares outstanding, which is actually 7.7 billion shares. That gives us a total market cap. In other words, a total equity value of the company of $796 billion. For Home Depot, the company with a higher share price, the equation comes out to less, as 177.88 times 1.129 billion only equates to a market cap of $201 billion. So indeed, Microsoft is actually worth significantly more than Home Depot, even though the share price looks less expensive. Let's talk a little bit more about dividends, which, as I said before, is one of two ways in which you can make a profit on your investment in a company. So when the company itself makes a profit, it can decide to do one of three things with the money. First, it could reinvest the profits back into the business. This is called retained earnings. Second, it could pay down existing debts or other liabilities it has in order to improve its financial position. Or third, it could distribute those profits among the shareholders based on the number of shares owned by each shareholder. And again, that is called your dividend or your share in profits. Now remember, not all companies have to do that with their money. Companies that are experiencing high growth or see opportunities to expand, they might decide to retain those profits and to reinvest in those businesses. Highly indebted companies may need to prioritize paying down those existing debts in order to improve its condition for future health of the company, to open itself up to future opportunities if it were to try to attract additional investors, etc. Now, as an investor, why would you decide that it's okay for your company not to pay you a profit or dividends? Well, when you do that, when you invest in these companies that do not pay dividends, you're essentially handing that money over to the company or allowing that company to keep that money for a number of productive projects that could grow and expand the business. So, as an example, a company could retain its earnings, not distribute them, and invest in a factory. It could put more investment into R&D, research and development. It could decide to invest in a new product line or a business idea, an opportunity they see in the market to expand. The expectation for both the company and the shareholder is that those investments, those profits that are reinvested, will in turn lead to the company being worth more than it is today. Think of a company like Amazon that uses its cash flow to continually dump money back into the business and expand its ever-growing line of businesses and services. All right. Amazon as a stock, if you were a stockholder, you would have made substantial amounts of money because of the share price appreciation, because the expectation is that Amazon is continuing to grow and in the future will grow to be worth more than it is today. Investing in a stock is always a decision made with an eye to the future, and retained earnings can be thought of as money today being put to work by the company to increase value. This next slide gets a little technical, but it is important to understand, and it deals with the dates that are critical in understanding who, as an investor, has the rights to receive a dividend payment. The three dates that you need to keep in mind are the declaration date, ex-dividend date, and the payment date. If an investor purchases a stock on its ex-dividend date or after, they will not receive the declared dividend. If shares held by the investor prior to the ex-dividend date are sold after the ex-dividend date but before payment date, the investor will still receive the declared dividend. In other words, the investor does not need to own the actual stock at the time of the payment date in order to receive the dividend. The graphic in this slide shows the dividend history for Apple. Apple has historically paid a quarterly cash dividend that has grown approximately 11% per year over the last 5 years. At the current stock price, and assuming Apple continues to pay a dividend equivalent to the past 4 quarters, investors would earn 1.92% on their money invested just from the dividends. Okay, that is not to say that that is assuming that there is no further price appreciation in the shares that you hold. That is simply the earnings. That 1.92% is the earnings that you are receiving just from the dividend payment. One last note, it's worth pointing out that some companies will actually pay dividends not in cash, but in the form of additional shares of stock. That's called a stock dividend, and that's usually a ratio of current shares held. Some stocks in the Junior Achievement Stock Market Challenge on March 1st will pay cash dividends. Teams will need to pay attention to the ex-dividend dates, and teams will receive a set dollar amount per share of stock owned prior to the ex-dividend date on payment date. Now let's shift our focus from dividend payments to the other way in which an investor can seek profit in owning a company. That is through the change in price of the shares. We call this capital appreciation or capital gain. So a company decides to go public, it has an IPO, and those shares that were issued during that IPO begin to trade in the stock market or stock exchange. Examples of a stock exchange include the New York Stock Exchange, the NASDAQ. In this market is the place where these shares are exchanged between buyers and sellers. And it's market forces of supply and demand that determine the movement of the stock's price. If more people are motivated to buy a stock, for example, than to sell that stock, the price is going to move up. And vice versa. If folks are more motivated to sell than they are to buy, we're going to see the price move down. A stock's price incorporates all the information that currently exists about that company. Recall that a stock price is the determining factor in valuing a company. A company owns stuff and it sells stuff. The stuff it owns, buildings, machinery, patents, money in the bank, those are called the assets and constitute what we call a company's book value, or the amount that the company could get if it were to sell all of their assets, their stuff at once. But more importantly, companies are businesses trying to make profits and to earn cash by selling products or services. So the total value of a company has to do with the stuff it owns as well as its ability to make profits in the future. And investors' differing expectations for and value of future profits and cash flow streams is responsible for stock prices moving up and down. So one group of investors might have high hopes or high expectations for future cash flows for a company, while another group might see it totally different, right? No one has a crystal ball. It's about looking at the market, understanding the world we live in, a company's position in that world, and valuing their position, their ability to earn profits in the future. Changes in a stock price are a reflection of the battle between the optimists and the pessimists who buy and sell given their different viewpoints and expectations. So determining the proper value, not necessarily what the price is today, but what is the true value of the company? It comes down to figuring out and predicting what news and developments are positive for a company and what news and developments are negative for a company. So as a thought exercise, if you had the choice today to buy Facebook or to buy Snapchat, which one would you choose and why? Here are some examples of factors that would increase buying or demand for a stock, thereby increasing its stock price. Expectations for increasing profits. The trend of earnings or profits for a company is the most important factor in determining the demand or the value of a stock. New products or services that positively impact the future outlook for the company. A company increases prices for its products or services. I think recently Netflix just announced that its subscription service is going to go up in price. All else being equal, if subscribers decide to keep the service and pay that additional monthly cost, that's going to be increased revenue for Netflix. Costs of key raw materials go down. So an example that comes to mind is the price of oil. That would benefit airlines because that's an input cost for them, and cheaper oil means lower expenses for them. Competitor stumbles or misexecutes. So Samsung has a bad release for one of its phones. That might be positive for Apple. And favorable economic trends. In a growing economy, growing companies are going to do better than in a recessionary environment. Let's talk about the flip side, some common factors that may actually increase the selling of a stock, thereby lowering its price. Number one, the company simply does not perform as expected. In session one, I mentioned that as a public company, there is a requirement to report financials on a quarterly basis. So if a company releases numbers that show its sales are slowing or earnings are not as high as expected, that could increase the selling of that stock. Competitors enter the market, introduce a substitute, increasing competition, taking business away from the company. That could create a deterioration in financials or earnings. If the cost of production or the cost of running a business are spike higher than expected, that would create headwinds. Increased regulation or product safety concerns. Let's say a key business line or a key customer stumbles or misexecutes, that could result in the loss of sales or a slowdown in sales. And of course, general economic trends. If the economy is slowing or actually declining, then you're going to see many companies, if not all, are going to struggle to grow sales to increase earnings, and that could have an impact on share price. What we're going to do for the remainder of the session is read some real life examples of company events that had an impact on the share price following the announcement of this information. I'd ask you to pause each slide, read the case study, discuss what you think may have happened to the stock subsequently, and then I will read out the answers. Following this announcement, Apple stock fell 10% on January 3rd, 2018. Who else was impacted by this announcement? Suppliers of key components to the iPhone. Dialog Semiconductor also fell 10%. Sage Therapeutics. Sage Therapeutics stock rose 43% on January 7th, 2018, following this announcement that its stage 3 trial results for a new drug treating postpartum depression symptoms showed meaningfully improved symptoms in patients. Johnson & Johnson. Johnson & Johnson's stock price fell almost 13% from December 14th through the 17th of 2017, as details of the Reuters report regarding contaminated baby powders were reported. Johnson & Johnson is one of the most widely held stocks. Oil exploration and production companies. The stocks of oil exploration and production companies fell over 40% from early October 2018 through year end on evidence of oversupply in the industry and concerns that the global economy may weaken. However, this article points out that major oil producing countries in the Middle East and Canada are taking action to cut production, which could bring the oil market supply back into balance with demand, which could lead to higher oil prices in 2019. This could help stock prices of oil exploration and production companies to improve. While the stocks of oil exploration and production companies suffered the last few months of 2018, can you think of an industry whose companies may see better earnings and stock prices in the coming quarters from the weakness in oil prices? Airlines, retailers. Chipotle. The stock price of shares in Chipotle Mexican Grill fell from a high of approximately $757 per share in October 2015 to a low of approximately $250 per share in February of 18, as the company has struggled to rectify its brand and take the steps to improve food safety. That's a decline of 67%. As of the beginning of 2019, the shares have recovered to over $450 a share. So certainly if you were a buyer later on in this timeline, you would have seen a significant share increase from 250 to 450. Netflix. Shares of Netflix were up 6% on the first day after winning big at the 2019 Golden Globes on Sunday, January 6th. Investors are anticipating that the company's successful push into original content will lead to upbeat subscriber numbers and higher sales and profits in the future. Barclays. An activist investor is one who seeks to acquire a large shareholding in a company's stock in order to use its voting rights to push for more change within the company's strategic decision-making process. In this case, the activist investor has been pressuring Barclays' board of directors and management to wind down parts of its investment banking division, which he believes is acting as a drag on the company's valuation and stock price. He is seeking to influence change by getting himself elected to the board of directors himself. Barclays stock was up only 0.2% on the day of this announcement. However, if the activist is successful in gaining a board seat and influencing strategy to improve earnings and profits, Barclays stock could see more upside. So I hope after today's session you have a better understanding of how stocks work, as well as the movement of stock prices. We've talked about seeking profit through both dividends as well as capital appreciation, how the laws of supply and demand and the flow of news and events into the market can affect the movement of stock prices. And we also looked at some real-world examples. Thank you for taking the time to walk through these webinars. I hope you found them helpful in preparation for the Junior Achievement Stock Market Challenge, and I wish you the best of luck.